This episode is brought to you by The Farmer's Dog, a service that delivers gently cooked, freshly made pet food straight to your door. Each balanced recipe is developed by board-certified nutritionists and clinically proven to support healthy aging. The Farmer's Dog, guided by science, driven by love. New customer? Get 50% off your first box at thefarmersdog.com/Spotify. Plus, you get free shipping.
Reality radio for a really great future. We're talking real money.
Hello and welcome once again to a Cynics Holiday. I'm Don McDonald, your holiday cynic, and this is talking real money about real money things from a cynic's perspective. The heck with these positive affirmations and Pollyanna-ish ways. No, I'm gonna throw icy water on all your wonderful ideas for the season. Ho, 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 ho. Sorry. Hi, everybody. Welcome to Talking Real Money. I'm Don McDonald, resident curmudgeon today, along with Tom Cock, who is in a great mood because he's escaping the cold tomorrow.
Glad to put all this behind me, frankly.
You thought I
was talking about the holiday, right?
Yeah, no.
I'm talking about snow.
You went from floods to snowfall.
Yeah, I know. Yeah, and these trees, you laugh at me about wanting to get rid of trees. So I was out shoveling, trying to move things around a little bit. And the trees, they know that I'm out for them. So they're dropping these huge hunks of water and melting snow. And I swear it, they got it in for me, man.
Can you blame them? Look at your stack of paper there.
Good point. I'm coming for you. So don't do that again. Yeah.
Well, welcome to near the end of the year. We're getting close to wrapping this year up.
I already moved the calendar right here in front of me to January 2026. So it's coming, man.
Here's the thing. We place this arbitrary deadline ending note point on the year. We say, December 31st, that's when the year ends. January 1st, that's when another one begins. Well, it's just one day following the next. What changes, really, from December?
Can't we blame the Romans for that or something?
I don't know who to blame, but why do we, here's what I want to grumble about. Why do we get so caught up in the end of the year? This started when I read an article in Apple News that said, worried about your finances in 2026? Here are five money moves recommended by experts.
It's always 5, too, unless it's Paul Merriman. Then it's 10. But for most
15.
people, it's a mere 5.
Yeah.
If you can do 15, you may as well do 20, right?
Keep going.
5. Yeah.
Why don't we just do this all year? That's my thinking. What is it about this point that, come on, are you really going to change? Are you going to become a different person on January 1st?
And actually, you're right. That's fair that people should be doing this all the time. But due to the fact that we know you're paying better attention now to these things because it's the end of the year. Are you? I am. You know me because I have my end of the year spreadsheet.
You're a traditionalist.
I got the plan for next year. Yeah, that whatever. Thank you. That's the kindest thing you ever said about me.
My guess is that somewhere during this show, you're going to give 5 things to do in 2026. I expect it. No?
You already know that because my 5 don't exist until next Saturday. They're already recorded
January 3rd. That's right.
But I do have a whole bunch of other people's 5s. So, sure, of course. And guess what? AI, if you ask them, they've got 5.
Really?
Yep. Well, just went ahead and said, what are the 5 financial things to do in the new year? And guess what? Pay down high-interest debt. Sure, that makes sense. Build an emergency fund. Absolutely. Maximize tax-advantaged retirement contributions, because I think next year in your 401k, you can put $24,500 plus whatever the catch-up is. It's a lot. Review and update your estate plan, which is always a hilarity. And then investing in financial literacy, which I love. Number 5. They should move up. That's number 1, because if you don't know anything about money, how can you do the other 4, right? So I love those, actually. That was from AI. Those are, it's
which AI did you use?
Enough. Whatever the
Chat?
The one, the one I'm on.
Chat gave me very different things. I just typed it in. Chat gave me different stuff.
What were the 5 you got?
Do a 60-minute financial reset. That's it.
That's too specific.
List every account, confirm beneficiaries, check asset allocation, raise your future self-tax before lifestyle creep shows up drunk and demanding upgrades.
as it always does.
Increase retirement contributions by 1% to 2% or more if you can. If you get a raise, divert at least half to savings. Kill expensive, unnecessary risk.
I was going to say subscriptions, but yes.
Well, high interest debt. Yeah,
list.
drop products you don't fully understand. Review insurance. Simplify your investments brutally. Complexity is not sophistication; it's camouflage.
Ooh. And this is the part that really is the struggle.
ChatGPT is better at this than I am. I'm turning
way
it over.
better. But this is the part that's really bad. Actually, these things are generic enough that sure it makes sense for most people. And if you're already doing them, as you said, Don. Hey, New Year comes, New Year goes, whatever. You stay up till, like me, 9:30, maybe even 10 o'clock, and ring in the new year. But many people don't do those things. And you're right. They should start anytime.
He does an East Coast New Year's.
Exactly. I watch the ball drop and go to sleep.
In New York.
But the problem always is, what are the 5 things to invest in the new year? I also
that's
asked
the one that
chat,
really
that
annoys me.
I looked around at a bunch of people that write and tell you the things you should invest. I mean, this is where the trouble really starts, right? Because people get told this is the way to go. This is the thing you've got to do. And most of the time, and you talked about this, predictions. If you're predicting, you don't have the knowledge. If you have the knowledge, you're not predicting, right? I mean, that's at the end of the day. So these people are predicting the things. And what's the number one thing that they tell you should invest in 2026?
What?
Guess.
I don't know.
Shock you. AI. Yeah. Right.
Now, what did AI say the number one thing to invest in is?
AI.
No. See, that's not.
Energy.
My
healthcare.
AI knows me better. My AI is number one.
What was the number one?
Diversified equities, U.S. and global stocks.
I've got some other suggestions people made. You can take those up, too.
And we'll take your calls, too, along the way as we share the 5 things to do. 855-935-TALK.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
We're back. 855-935-TALK. It's not 800. That's the office. 855-935-8255 is our telephone number. In this hour, we're talking about things to do next year. Well, maybe you should have done them this year. I don't know.
Yeah, there's a whole bunch of them you should have done this year, and we've discussed some of those. By the way, before we go on, I want to say happy anniversary to my wife. Today's our anniversary, so I'm doing the show kind of under protest. She insisted, actually, I do the show. So
well, then it's not under protest.
I love you so much, honey, so thank you for putting up with me the way you do, which is, as you said earlier today, Don, not an easy task for anybody. But some other writers, it's a fascinating thing to see what. So, for example, Motley Fool, what are they telling you to invest in for next year? NVIDIA. Yeah, that should be a good one. Because didn't it go up quite a bit?
A lot. Last couple of years. Yeah.
And then a couple of companies I have not heard of, the Trade Desk and Mercado Libre. I don't know those. Morningstar tells you the consumer defensive companies, financial services companies, and healthcare are the place to be, which all had good years again this year. And then my favorite, there's a writer that I know. I'm not even going to mention his name. He writes regularly. I read his stuff on I think he shows up on LinkedIn a lot. And he tells you defense stocks, that's the place to be in 2026. So,
well, here's the thing. Now, ChatGPT told me diversified equities, number one. Okay, global and U.S. And then went strategic tech and AI, real estate, value and defensive stocks, diversification and inflation hedges. So I said, you should have quit at number one.
You had it there and leave it.
So here's how she responded. I call her a she. She goes, fair, and you're right. Number one is the answer. Everything after that is garnish people argue about on TV.
Yeah.
So let me rewrite this in an honest way. The best investment for 2026 and 2027 and 2038 is a globally diversified, low-cost equity portfolio held patiently, rebalanced occasionally, and largely ignored. Full stop. Numbers 2 and 5 are just different ways people try to feel clever while doing roughly the same thing, usually with higher costs and worse outcomes.
And more taxes and more expenses. All those other things are pay attention to. So that's really good advice.
Brutal honesty there. 855-935-TALK if you want us to give you some brutal honesty about your situation financially, or you want to share something, or you just want to ask some question. Give us a call, 855-935-8255, just as Brian in snowy New York has done. Hi, Brian. Welcome to Talking Real Money.
Hey, guys. First of all, Tom, happy anniversary.
Thank
you. How many years is that?
Let's see. I don't know.
He lost count. He's in trouble now.
18. I think it's 18 today. Yeah, 18.
Well, congratulations.
Thank you.
Hope you guys had a nice Christmas.
Great holiday. So hope you as well.
Thank you. So the topic, I want to talk about the 529, specifically the New York 529, and then my follow-up, the Trump accounts, and I'll bridge them together. So my son is 8 years old, and I've been doing the New York 529, which is a good account since he's born. You get up to $10,000 a year state tax deduction,
which matters in New York.
A big deal there, absolutely. Yeah.
So, and I'm doing it, but I'm not going. And I was hesitant to do it too much early on until the new law, the Secure Act, with the rollover to the Roth IRA. So it gave me a little more cushion to be comfortable with it. So I'm approaching about $100,000 in that account, and then I think I'm just going to stop the contributions and let it go, because my thought is I'll fund him up to the about of whatever the cost of a state is. I'm not going crazy with these $80,000 a year private schools. It's nuts. He can figure it out.
Wait. Which one's only 80? I got to find that one. Send it on over here, would you, Brian? I appreciate it.
Poor Tom. Tom. And literally, it will be poor Tom after his daughter goes to college.
Keeps me young, keeps me working. There you go.
So in my mind, I'll fund him about the state college tuition, whichever state we end up in, New York or potentially Florida. So I've been aggressive. The age-based funds, it's like they're like target date funds, and you pick the year they're going to college. And I find it's almost too conservative. Or they give the option to go on their own. They're very good. The low cost. It's through Vanguard. It's their low cost index funds.
Yep.
Total market, total international, all of those. So I've just been basically a little small cap, a little value, and total market. But I have not gone into the age-based fund. And
they're age-based. I got to tell you, they are pretty conservative. I'm looking at them. I mean, for a kid going to college.
For an 8-year-old, how much have they got in bonds?
For a kid going to college in 2044. That
sounds like 19 years from now or something.
It's 40%. No, I'm sorry. It's
what?
No. It's still 5% in bonds, and that's 20 years away. So they're relatively conservative. Okay. Yeah,
I could see that. Sure.
Yeah, 2030 is.
So
what is that? Yeah, that's a lot. 50, 60%.
So I think he's about 2035. So I'm not even going with that one. I'm just trying to figure out when to start dialing it back, but also knowing that maybe it can stay a little bit aggressive because any leftover funds can go to a Roth IRA for him later in life.
There you go. There's a reason to maybe oversubscribe a little bit. So even if you figured out the funding of the school part, you could still have the other 35,000 in there that could supply his Roth IRA, which is
that could
great.
be more. That could be 100% equities. Yeah.
So I'm just trying to figure out where the balance is of when to start going a little more conservative with it.
The balance of when to start going more conservatively is you need to then spreadsheet out what your expected costs are year 1, year 2, year 3. You really want year 1 and 2 to be almost 100% fixed income.
You're saying when that year arrives?
Well,
right. So in
as
10
you
years,
get close
basically?
to that year. That's
right.
You want
so
that.
He's asking now. I think now to be 100% equities fine.
I could be aggressive now because of the amount of time you have. I would not be particularly conservative because we haven't had a 5-year downturn in decades.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-8255, our telephone number. Give me a call. And we are continuing with Brian. He has a follow-up to the question about the 529 plan and saving kids for college and Roth IRAs. And Brian, what else you got?
The follow-up, thanks for keeping me on. The Trump account, starting next year in 2026, I think new babies get $1,000, but it looks like anybody under age 18 can fund up to $5,000 post-tax money, but then all the earnings are you would pay taxes on the earnings, but at age 18 it turns. I'm just asking what the rules are. It turns into a traditional IRA, and then you could actually roll it over to a Roth IRA without earned income. And I'm trying to see if this is actually a benefit, the Trump account.
Yeah. Oh, boy.
I don't know that all the rules are established yet about the rollovers and that sort of thing.
It's really, hold on, I'm going to make sure I'm right. I don't think so. I think that they can be converted to a regular, but I don't think they can be converted to a Roth without paying taxes. And I think
wouldn't
there has
make
to be
sense,
earned
of course.
I thought there had to be earned income. Hold on. Let's see.
But there are, in terms of the receiving the money, aren't there income limits on that as well?
Yeah.
Not in terms of the child, but in terms of the household. Everybody gets $1,000?
That's for Michael Dell's money.
Oh, okay. That's right.
That's for Michael Dell's money. I'm trying to find it.
Well, wouldn't it work if you just keep it simple? If you put in $5,000 one time, and over time it turns into $10,000, so you got $5,000 a basis and $5,000. Then you want to convert the whole $10,000. Wouldn't you would pay taxes on the $5,000 of earnings? So it's kind of like a messy traditional IRA conversion with basis in it. Wouldn't
a Roth conversion
concept?
Yeah, I think so. But here, I just wanted to. There's. Let's see. Okay, the conversion rules. Yeah, right. Okay, that's what you're saying is right. Now I don't know if there's the
So in other words, any gains in there, and you want to move the whole thing to a Roth, you're going to pay tax on the gain portion only.
Yeah, there's no special rules, no nothing. It's just because it's a tax deferred account. It can be. Oh my gosh, this is all so convoluted, and I really have not read that much because I personally don't think this is a very big deal. But
other than it's $1,000, $1,000,
well, for a kid, I take free money. I'd always take free money, and if you qualify for the Michael Dell 500 or whatever that is, take that too.
Absolutely,
take their money.
Because then it would just grow as an IRA then for all those years, even if you did not convert it, right? So then the money would come out and you'd pay regular income tax on it. So it would still be advantageous in terms of tax deferral.
So you know what? I'm not finding any definitive answer. Which is
hard to imagine something from the government not having a definitive answer. But at the same time,
think about it. The 10-year inherited IRA rule took until the past few months to get a definition of what you have to do in terms of when that money has to be taken out. So I'm telling you this. You have stumped the band.
Next time, ask for $4. Maybe we'll get it.
But I'm going to do more research. I promise.
Yeah, I'm just trying to see. I mean, the 529 is good because it's all for qualified. It's all.
Yep, and then you'll be able to take the 35 for the Roth, and I don't know. So, there's nothing wrong with free money. That's great.
I wouldn't put any of my money in it yet.
Yeah, I wouldn't because I don't see the reason why, especially when you're able to do this sort of backdoor Roth contribution you can do with the 529 plan. So I see no reason for doing the other account.
All right. Well, you answered my questions then.
Well,
Just
sort of.
some
Not really.
thoughts.
Thanks, Brian.
thank
Thanks
you,
for
guys.
listening. and
Okay,
reaching
thank
out.
you much. I
Happy New Year.
appreciate it. 855-935-TALK is our phone number, 855-935-8255. And again, I'm looking at multiple places, and it's just clear as mud. It's just clear as mud. Yes. Okay, the things we know, it's post-tax contributions, and they grow tax deferred. Those are the two things I know. There you go. That's the extent of it. We'll be back with more of your questions and our commentary and sometimes being stumped.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
All right, first, let me get rid of my headache from looking the stupid account
Yeah, how'd
up.
that go?
I'm
Yeah.
sorry. I hate that. By the way, and this is not even political. This is just, I hate this. I don't care if this was Biden proposed or Trump proposed. This is pandering. This is
Well, there's just no reason for it. There's
it's
no
like
need.
buying
free
votes.
money's free money. Yeah,
Yeah,
well,
I don't
didn't we
like
just give
it.
every member of the military $1,776?
Folks, one, this does not exist. Okay? Doesn't exist yet. It's merely an idea that has been tossed out there. It's not legislation, no rules. Okay?
But does it need legislation, or can
Yes,
the president
it
sign an
needs
executive order and just
legislation.
say everybody gets $1,000?
Well, I don't know that anymore. I have no idea. I studied this in school,
Remember
and
when there was a
apparently what I
Congress and
learned was
everything?
wrong.
Sorry.
I'm sorry. Apparently everything I
That sounds
learned
bad.
is wrong. I thought we had 3 branches. I'm confused. But anyway, this does not exist. It is proposed. It would give newborns $1,000 at birth. It would allow family members to contribute. It would grow tax deferred, and you couldn't take the money out until sometime in adulthood. By the way, as proposed, it would not be rollable or transferable into an IRA. It would not
into
be
an
convertible.
IRA or a Roth IRA.
It would not be convertible to a Roth.
So it has to be sold separately the rest of their lives?
The rest of their, yes. And we don't know the
too
details
confusing.
yet because there are no details yet.
Feel better
Are
now?
we done?
Headache gone?
No, my headache's even worse now.
And usually by the end of the show, you feel better.
I
so
do.
sorry.
I feel like we did something positive, but now I don't. Now it feels all negative. Hopefully,
Please call and rescue
Larry
us.
in Seattle will. Well, we got callers.
Okay.
Tis
Well, no, I'm
the
just saying
season
rescue
to
us
get
from
callers.
our...
Larry's going to ask about something other than Trump accounts, I'm sure. Larry, welcome
please.
to Talking Real Money.
Hey, great show. What I'm doing is I'm trying to encourage my grandson to start a Roth IRA. He's around 19, so he has 40-plus years to invest, and I was wondering what a good single fund for him to start with.
Well, there's several, actually. But you could...
He asked for a simple answer. What are you trying to complicate this? Jeez, it's like you're
go left.
It's like you're
driving
doing a
at
Trump
35
account.
miles. Okay, here. You ready? This actually, Larry, thank you, Don, for straightening me out. It's very easy. Avantis Investors has a single fund. It is global. It holds a global basket of stocks, somewhere around, I think, 9 or 10,000. It uses factors in it that the academics have identified as providing perhaps a little more return than just an index fund.
Perhaps.
And it does it at an extremely low cost. I think it's like 0.23 or something.
I think it's 0.23.
And here's the ticker. Because, by the way, we had a lot of questions about
You
this
wanna give
over
the
the
ticker?
holiday. No, you give the ticker.
Oh, AVGE.
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 It's easy. Yeah. And by the way, your grandson could hold that fund for 40 years and it'd be okay. I mean, it should grow and,
go up.
and
It's going to go up and sometimes it's going to go down and then it's going to go up and then it's going to go down, but it should go up a lot more than it goes down. At least that's the whole idea. That's why
it's a
we
great
like
one fund solution. I think I got 3 or 4 questions over the weekend from people saying the exact same thing. Larry, hey, I want to do this for my grandson, kid, whatever. What's a one fund solution? It's a wonderful one fund solution.
And it looks like our next question
Okay. Is there a minimum deposit on that, like $3,000 or something?
One share.
Well, okay. What's one? I didn't look it up, but you have to. It's no
$86.84 minimum.
So you're going to need. Can you cough up $90 there, Larry?
Okay. And that's better than maybe this Vanguard Total World Stock Index that you have, this Vanguard 2-fund portfolio.
It's more interesting. It's more interesting.
Oh, now investing needs to be interesting.
Yeah, well, no,
it's
it's more interesting in that it follows some academic research that says that, and for good reasons, that stocks that are undervalued because they're cheap
and smaller
and
have more momentum
tended in the
and
past
have bigger
to grow
profitability.
more.
Yeah.
And
here's the thing. We don't know about the future.
And
the
let
past
me tell
looks
you,
like it would have made you more.
If
Yes,
you
but we
did
don't
VT, I wouldn't gripe.
know. No. Or, by the way, for that matter, because we're going to just confuse you, DFAW.
Oh, jeez.
Any of those three would be fine.
It's only because our number one word of 2025 was Avantis.
Avantis?
Avantis.
Avantis?
It's going to be 20. Oh, it's still 2025.
Still 2025.
Thanks so much for the call, Larry. Good luck with that AVGE or DFAW or VT or
VT.
whatever the heck you buy. Let's go to, let's do it. Let's go to somewhere in California because it's about the same thing. Siva, welcome to the show.
Good afternoon, Don and Tom. I've been a fan of the show for many years. I read your articles and also occasionally listen to the podcast.
Awesome.
Since you talked about AVGE, there was a recent article by some no-name writer, if I want to say that, in Seeking Alpha. He goes to say AVGE, this is the title, AVGE strong start, but shaky end in mixed 2025. And I don't know why he says in the end, I rate AVGE a hold, recommending a wait-and-see approach given its persistent underperformance and the availability of better passive alternatives.
First of all, it's not passive for one thing.
Yeah, and
in the traditional sense.
And let me tell you,
and 1 year of performance, I really don't care.
Exactly.
That doesn't matter.
This
to
is
me
a guy.
I'm surprised.
I know the article. It's by a Nicola LaPena, and he says that it has underperformed a passive all-country world index portfolio. You know why it has? Because it's more aggressive than an all-country world index, and the ACWI is dominated by the 7 biggest stocks in the S&P 500. Yeah. So, it's underperformed. We're not looking for in or out of favor year to year. It's a more aggressive fund because of its structure. It should over time outperform if it performs as the past has indicated it should. But we don't know.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Okay, I'm not going to call this guy names like dummy or idiot. I'm not going to do that. I'm just going to say he's uninformed. Because first.
Now you're talking about the author.
I'm talking about
piece.
AVGE and the author of the piece in Seeking Alpha, this Nicola guy. He's wrong because he's doing exactly what we tell you not to do. You're judging a strategy by short-term performance. That is a mistake, and he is absolutely doing that. He says in this article, and I'm going to quote this. This will tell you everything, Tom. Everything you need to know about this guy's perspective.
I've been waiting for everything in one quote, too.
Everything. And I just lost it. Okay, here it is. Ready?
Oh, yeah.
He doesn't like it because he doesn't believe that, quote, the fund manager has found the right sector and portfolio balance in global equity to ensure strategic outperformance. Basically, he's saying
that they don't try to do that.
Right. They don't. AVGE, the global, are all of Avantis ETFs. They're not trying to win. They're not. They're rules-based, factor-tilted, globally diversified funds designed to behave differently than the standard market cap weighted index. That means sometimes they're going to lag when the market cap weighted is doing well.
And by the way,
that's not a flaw.
It's up. The fund is up almost 21% year to date. What is the all world index. I mean, that's a pretty good number.
Hold on. I'm going to have
in
to
a year,
tell
by
you.
the way, where international small cap value is up almost 50%. So it overweights to some of the things you would expect to do better. But
I'm going to tell you. But this
this is, again, not a reason to buy or not buy a fund. That's the point. You buy it because it fits in your portfolio to fit a certain part of the portfolio. That's the only reason, not because it's done a little better, a little worse than the other one over the last year or so.
Yeah,
Silly.
you buy it. Well, and by the way, it hasn't beaten the index. It has underperformed the index, but its category of funds, according to Morningstar, which are a value tilted, a factor tilted, they
Correct.
beat the rest of the actual funds to which you should be comparing it. For example, the category, not the index. The index over the past 1 year, the A,
a little. The end of 2024 and the beginning
right,
of
over the past 12
Because we got
months,
a few more trading
the
days. Yeah.
index has returned through Friday 21% per year on average. Okay, AVGE.
When you said per year
for
or
that 1 year
21%?
for that 1 year
For the last year.
yeah, 21% over the year.
AVGE is pretty close.
20.24.
Okay, really?
Really?
Are we really?
Really? Because this guy's trying to be relevant.
I get it. You're putting it out there. Somebody's got to read it, or there's no reason to do it. But that's a very silly. Anyway, yeah, letting it go. But
Well, I'm sorry, but I had to make the point. I mean, because
the
it's
point's well made.
If you're buying AVGE, you're not looking to score big every year. You're looking to slightly outperform over the course of many, 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 many years. That is what. Give up this performance chasing. It's not. You're always going to be upside down. You're going to be behind the curve.
It's the people that telling you now to buy Nvidia.
Right, because it
was
already
up over 60%.
did well.
Exactly. Why would you buy? And that doesn't make sense either. So
let's go to I love this place. Beautiful. Really? Literally, when I say beautiful Whidbey
Hawaii?
Island, I mean beautiful. Whidbey Island is gorgeous. Caroline, welcome to Talking Real Money.
Hi, how are you?
Good. How are you?
Okay. So I have a couple questions. So, planning for retirement. I'm 67, and I am wondering how to handle my money that's in an IRA with Vanguard, and how do I get it into more of a tax-free zone other than a Roth? And then, like, say I have $250,000 in my account. That's not really how much I have because IRS is going to scam off quite a bit, right?
Well, okay, the last account you mentioned is just a regular brokerage account or taxable account?
It's in Prime Cap.
But that's
Prime
the fund
Cap.
it holds. But how is it held?
Is it a brokerage account or an IRA?
Yeah. I have both. Most of it's in the regular, but some of it's in the Roth.
In a Roth. Okay, so the stuff in the Roth you're not going to share with the government. You're not going to share that.
That comes out tax-free.
The brokerage account, someday when you take money out, you're going to pay capital gains tax on it.
Capital gains tax, not regular income tax. Stuff comes out of the IRA is going to be taxed at your regular income tax rate.
She said she had a Roth and a brokerage.
No, she said at the
both
beginning
guys?
she said she had a lot in an IRA.
IRA too. Okay. Sure.
Yeah.
Most of it's in the regular.
Regular IRA or regular brokerage?
It's the IRA.
IRA. So it's a traditional IRA and a Roth IRA. Got it. Okay. I'm going back to my corner.
Yeah.
Okay. So in that case, yes, the stuff. So what you're going to want to do, Caroline, is to, first of all, figure out what sort of income needs you have. Then what you could do is figure out how much of the IRA and perhaps some of the Roth to either stay in the same tax bracket or not pay too much in taxes 1 year and pull from each account. Or, as I would prefer it, you just take money from the IRA, let the Roth continue to grow because you want tax-free things to grow tax-free. But you're right. There's some complexity to the withdrawal part of all this that most people don't think about. Part two is I'm a little concerned if you're just in Prime Cap, but that's a whole other
Prime Cap's not a great fund.
day.
But I want to go back because you said get it tax-free. You can't get it tax-free. If you take it out and put it in a Roth, which will grow tax-free from then on, you're going to have to pay taxes when you make that conversion. So there's no way to go from having to pay the government some to getting out of it. You got to pay them now, you got to pay them later. One way or another, you're going to pay them. 855-935-TALK is our number. We'll be back really quickly.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
You are always invited to participate in the show by calling us on Saturdays at 855-935-TALK, or you can send stuff in at TalkingRealMoney.com on the contact form, like these pieces of paper Tom has that made the trees
my war
mad.
on trees continue. Jason, and they're looking for me too, wrote us from Bowie, Maryland, and said, I hear Don asking on a regular basis for Talking Real Money podcast to be rated and reviewed as feedback.
Yeah.
I listen to the podcast via iHeartRadio.
Oh, you can't
and
do
so
it
far
there.
I've been unable to rate them. Kent doesn't know how to do it, so please mention on the air if you can.
Yeah, you
well,
can't.
First of all, if you don't listen to the podcast, you should.
Right.
It's
But
so easy to do.
There
in
are
today's
really
world.
only two services that allow a ranking, particularly, they're the two big. iHeart is up there. It's like top 3 or 4 for us.
Yeah, I think it's top 4, yeah.
Yeah. But the only two that on which you can rate us are Apple, and Apple allows the writing of reviews, or Spotify, which allows just ratings.
Yeah.
And
so,
if you
but
like
he could
us,
go to Apple and do the.
you could do it.
review,
Yeah,
right?
you can just.
Yeah,
I mean, the Apple
correct.
app is free.
Even if you still want to listen to us on iHeart.
Yeah, you could go and get the Apple app for your phone, no matter what kind it is, or for your computer, no matter what kind it is, and you go to Talking Real Money, and then you can rate us there.
I had to do this at a party the other night with a bunch of guys my age who still mostly listen to AM radio, and I said, "You really? I didn't know you could do that." So I showed them on their phone. You imagine me leading a conference on technology?
I cannot. I'm
I
sorry,
see the
but
hives breaking out.
my headache just got worse. I'm going, wait, no, what universe am
Not
I
gonna be
living
enough
in? Tom helping
migraine
people with
medicine to fix
technology?
it. Exactly. So go to check the podcast out. There's all kinds of additional stuff. We do 5 a week. So if you can't get enough of us on Saturday, imagine that. We have people listen to us every day, and thank you for that. So take advantage of Talking Real Money, the podcast.
You know, I think I need to redo the cover because you look definitely older, as do I, than that cover picture.
No, I like the cover.
I like the cover picture.
Yeah, still a little color in the hair and everything. It looks good to me. So.
Oh gosh! Oh, we just got a new review. It was 5 stars,
As we're
thankfully.
speaking. Okay, there we go.
Of
It's the
course,
holidays,
of
should be
course,
nice.
Don listens to John Oliver, like
Yes,
a
of
normal
course he does.
Floridian Republican would do. Are you saying that Republicans can't listen to somebody who's liberal? I just find him funny at times. Now, okay,
In today's world,
your other podcast
can't
should
listen
be
to
called
anybody.
Lib Reading. Keep up the good work. Keep up the great woke. The great woke. Oh, my
the great
God.
woke.
This is what I don't like: is that if you deviate from
Yep.
the
Can't do it at all.
the scriptures, according
That's
to
it.
whomever.
The scriptures. Yes.
Okay. I am a Republican. Check my registration. I voted for the Bushes. I did. I voted for the Bushes.
But that's where it about ended, too, I think. So
That's right about where it ended. Okay. Well, we're running out of time. Couple of things you can do. You can
this is going to end, too.
You can go to TalkingRealMoney.com and send in questions. That's really easy. You can even speak them into us. We love that. But here's the thing, Tom. He gave us 5 stars, so I got to give him
Kudos for that.
Kudos
Thank
for
you.
that. 5 stars. Okay. So he likes the show. He just thinks I lean left. But my God, how much righter do I need to lean? I mean, I'm a capitalist pig. I don't believe in redistribution of wealth. I don't. I believe in fairness. I kind of believe in anyway. If you want some help from us, go to talkingrealmoney.com too, and you just click on that form that says Meet an Advisor. No cost, no obligation, no high-pressure sales pitch. Best part.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.